Traders and investors, it is Wednesday, March 12th. Hopefully everybody had a good day yesterday. I was out skiing anyways, another funny note. I'm in a temporary office as I have some renovations going on right now, and I've been doing these interviews. The ones I do through Zoom, I've had this weird, the lighting is really off in this temporary office. I'm like, why do I have like this funny look and this dark lips? And I realized yesterday when I was tinkering around, for some reason, the lipstick was turned on my Zoom avatar. I was playing with it like a week ago, and I realized I was putting mustaches and eyebrows on myself just for the hell of it at one point. And I guess I left something checked with lipstick on. And so I have a few interviews out there over the past week that I have darker lips. And I was wondering why I couldn't get rid of these dark lips with no matter what lighting I did. Anyways, kind of funny. Anyway, let's take a look at the markets today. We have equities trading slightly higher. The futures had a big spike, but actually, if we look at the SPY real quick here, I think we just had some economic data come out. It created a quick spike, and SPY, everything is back down. It's not really up as much as we can see here, but the market is drifting higher. We had a few things unfolding. We've been talking about how the market is putting in what looks to be a little low here in the market. We have a cycle, multiple cycles to the downside. These red sections here usually are standout lows on the chart. Hard to see here, but we've got another one here. We have another one that was back over here as well. So we have this cycle low, and again, you don't want to try picking a bottom. I know a ton of you are picking bottoms. I know a bunch of you. Well, I know one person for sure loaded the boat right over here, and then of course the bottom fell out. I do think the market is going to recover back up to the 20 or 50 day, but the longer it takes, obviously, the more those are going to come down, and the bounce might be smaller than we think. But overall, everything is here for an oversold bounce. And we'll have to see how this bounce plays out going forward. If we get a bounce, for all we know, we could continue to go into a waterfall sell-off. And what I found interesting, last night I shared it in the members area. The hot list of what sectors were most active yesterday was all the weird, aggressive sector ETFs, telling us that aggressive traders are picking a bottom and they're moving into all the most volatile stuff because they want to make quick, big, fast money, which generally isn't as easy as it sounds in the market. So I am a little worried that if people are trying to pick a bottom here, that the bottom might not be in yet. And that's why we don't want to pick a bottom. People thought this was a low. I thought we were going to see a bounce. The bottom fell out. Seems like people are thinking this is going to be a bounce again. And for all we know, it gets sold into and we have another big leg down. So it is very difficult trying to catch a falling knife and not getting cut. And you don't know how much momentum there is. At this point, looking at this momentum, there is a ton of downward momentum. It could just be one of these green bars here before we go into another drop. So be very aware if you're trying to pick a bottom, it goes against everything. I have done this a long time, and generally, if you nail one, all it's doing is reinforcing your thoughts that you can time the market. None of us can really time the market. That's why we follow the trend, and that is the most important thing, but people just don't want to believe it or do that because it's not as fun, and people want to buy the lows because it feels great, because you can have very strong returns, very strong bounces and rallies or breakdowns if you time it properly, but in the long run, you're going to lose most of them, and that's probably why most of you are at this newsletter, is because we all fall victim to this. I mean, it's just the way our brains work. Let's pick a top, let's pick a bottom. Huge money can be made, but it actually doesn't really work that way. When you net out your returns in the long run, you won't have returns, good returns. All right, so let's take a look where things are going today. It looks like NASDAQ is up the most. I'm going to go take a look over at the MAGs. Let's just take a look at the MAGs ETF pre-market. It is up, so probably going to see the tech bounce. The tech space has been oversold the most, so I wouldn't be surprised, mostly the Magnificent Seven. I wouldn't be surprised that they do have more of a bounce, and the NASDAQ outperforms the rest of the market. It was interesting. We saw the Dividend ETF really get hit pretty hard there yesterday. We saw it was acting as a bit of a defensive play. People were moving in, and I feel as though it was, a wave of advisors. Actually, I talked to an advisor yesterday, and he says the calls he's been getting last week have been insane. Obviously, people panicking, wondering what to do. And of course, advisors say the same thing. Oh, this is an opportunity to buy more. And so we saw two very big, strong days in the dividend space. We saw dividends rally like 3.5% almost, while the stock market was fumbling and falling. And that's because I think all the advisors are saying, hey, this is buy the dip. This is a great opportunity to get in. And of course, a bunch of people piled in and then more selling hit. And now we've seen the dividend space actually fall down more than that. And you're underwater. And it's just funny. It's amazing how these markets move. I mean, I've followed this for so long and I keep track of all these little tiny details because the devil is in the details. You know, the difference between a beautiful, gorgeous house that's worth a fortune and a divey rental place, they're all built with 2x4s or 2x6s and drywall. It's the finishings, it's the fine details that make is what makes something nice. And these are the little tiny things I pay attention to, and I've got feelers out. That's, you know, I try and weave this stuff seamlessly into all of my analysis so you guys get the insight of what's going on. But it is very important to pick up and understand these little things. And I'm worried this market could continue to go even lower here. I know some of you are picking bottoms. And again, even if you nail it and the bottom is in for now, it's going to get you later when you do another one and it fails epically. That's the reality of the markets. All right, so money is flowing into stocks today. It is flowing into the dollar. We have the dollar index up 0.3%. Not much. It continues to struggle with Trump and tariffs and all the uncertainty in the U.S. We have gold up a little bit. Which gold is obviously has kind of the nicest chart pattern of them all, continuously just pause, rally, and is kind of in that phase. It dipped into an oversold territory 2 sessions ago and had a really nice bounce out of there. Silver had a nice move up and having a nice move up again today, again near the upper end of its range. We've been talking about how it could go to potentially 35, 36 to the upside and continue to stretch a little bit higher. But in the grand scheme of things, again, when we look way back in time, we're nowhere near the highs like what gold is. And silver will tumble very quickly when the market does fully turn over and sell off. Now, yesterday we did see miners really come to life. We saw silver and junior miners, lots of volatility, big pops, big drops. This is the sign of uncertainty, but they definitely had a very big gain. I like gold miners more than silver miners. When you look at them, they kind of, are trading near the up top right side of the chart in this time frame, which is pretty nice. If we flip over to silver miners, I believe they're in kind of the lower right-hand corner. Yeah, they're down below a whole bunch of previous lows and really still kind of struggling and somewhat have a bit of a bearish pattern on the when you zoom into this chart. So not a big fan of all those. You can see silver miners are still in at red bars, which means a downtrend. It keeps popping into oversold territories and sellers keep getting in, and we'll see how it goes. They are set to open higher today. And they are favored. The precious metal space is in that sweet spot. Again, I don't think miners are the play. I think just straight up gold. If you need more excitement, get a leveraged gold play or trade gold futures for even more leverage. But the miners are going to be a wild one. They're going to swing 4 to 5% on a daily basis sometimes, and that is a ton of risk, and you don't know how they're going to move with the market, against the market at any given time. What else do we have? Let's take a look at Bitcoin, up 0.5%. Bitcoin not looking all that great. We did play Bitcoin as a very one-off speculative trade. We got long here. We took off 14% gain here. A couple days later, we took the rest off right up at the high here with our Fibonacci move. Since then, it's put in that double top, and now it has more or less broken down, and it came up and had a kiss goodbye, and it has a bearish-looking pattern. We'll see how that unfolds. It might put in a bottom and a bounce with the stock market here. They kind of move together. But overall, the momentum has obviously gone from an uptrend to a downtrend. And you really don't really want to hold stuff that's in a downtrend. That defeats the point of what we're trying to do as investors, of holding things going up in value. Now, if we take a look at the hot list, GDX and silver miners at the top of the list. Same with gold, and this here is the gold chart. Obviously, nice and strong, stable, low volatility, a pretty good play. It's one of the better plays if you were to try to do something. I think, you can see this continue to push up a couple more percentage points. Other than that, let's go take a look over at, we had a member asking about what about some different country ETFs and global sectors and diversifying. So this is obviously our TTI long-term investing chart. We have our buy signals, our bearish trends, our bearish trends. We're still in a bullish trend, although it is getting very weak. And it's really coming down to just momentum and some technicals stalling out here now before we potentially go into another little bear market, which could turn into a stage 4 financial reset. But take a look at this. People were wondering, well, why don't we own some different country or global ETFs? If we take a look at, let's take a look at Canada, for example. If we look at Canada, which is the white line, just notice they pretty much move in sync. When there's a bottom in the U.S. stock market, there's usually a bottom in the Canadian stock market. When it's in an uptrend, it goes up. Usually the highs and lows are pretty much in sync. Now, obviously, there's percentage swings larger or smaller than the SP 500, but realize the stock market globally is a tide pretty much. Let's go and take a look at one more here. Let's look at the global ETF. Now, this is the rest of the world all combined together, getting rid of the U.S. markets, and that's the purple line. Notice they put in bottoms, they rally together, they generally top together, they have the same moves, and this is why diversifying and holding a whole bunch of different countries to me makes absolutely no sense. They have a lot more instability, a lot more volatility and chop and noise. Just follow the U.S. markets. They're the most liquid, the best trending, and they don't have all the crazy noise that comes with other country stuff. And of course, if we're not in these countries, we don't know what's going on in them. So the less you know about an asset that you're investing in, the more risk it carries. So that's kind of them in a nutshell. Now, there is the occasional market that will kind of buck the trend even more, which is the China one, which is the yellow line. But you'll still notice when there's a low in the SP 500, there's usually a low in the China markets. They rally up. Now, some of them might top out and bottom at slightly different times, but overall, the trend is still kind of there. But again, noisy. China is, very manipulated, controlled, all kinds of stuff going on. You don't know how it's going to react. They're changing rules and policies of making people have to only hold Chinese stocks and not hold U.S. stocks. It's all over the place, right? So when you mess with these other countries that are highly manipulated, I think all markets are manipulated, including the United States. But to me, China is like a real rat's nest. I would steer clear of it. When we start a new, bull market, potentially in a year or two, then some of these other country ETFs could have some unbelievable opportunities. And we'll look at those when they come. I remember during the last financial reset, I think it was Ireland. The Ireland ETF rallied like 400% so fast, had a great opportunity coming out of the bull market. So there's things we can do when the time is there, but we're really in a really crappy market condition. We've been in a stage 3 for a long time. Whole market's driven by magnificent sevens. We got, a new president, all kinds of crap going on. So that's the key, is just to realize we're in a tough market. And if you're not losing your shirt, you're doing well. That is the reality of it. There will be a time here we'll be able to really start pulling more money out, a lot more money out of this market. But the market goes in waves of winning streaks and the waves of really boring sessions, which is or streaks that we've been going through and we're working through. Other than that, I think that is about it. Let's take a look over at the NASDAQ real quick. If we take a look at the NASDAQ, this will give you a bit of an idea of what's kind of going on. So, just going back over here into September, the market's gone up. We had a couple signals, and you can see how the market's collapsed. Like when you look back here, the SP 500 is down about 2%. We got out of the bond ETF, which I know some of you held, and I know some of you still hold because you're looking forward. It's amazing. If I give really bullish scenarios for something, not everybody, but a good chunk of people just hear and see that, and they just do it. And so we got out of bonds over here. We moved into the equities market, and we pulled some money out on that trade. A lot of people held bonds, which fell like almost 15%. They are still down about 8%, and that's because when I show you the big picture, I think bonds are going to be a great trade in due time, not right now. And so either I know some of you are holding bonds and you're still underwater big time. The 60/40 portfolio is well underwater. I mean, you got an average of both of these. So it's underwater. This is why we don't want to just buy and hold, and this is why we don't fall in love with something because it sounds good later. We really just need to move out, protect our capital, and that's exactly what we do. So that's about it for today. Nothing too exciting. Let's just see how stuff unfolds, and we'll take it one bar at a time. Talk to you soon. Bye-bye.